Esta noche, Reshaping Financial Risk Management After Turmoil. John Hull, Autoridad Mundial en Derivados. Eduardo Canabarro, anterior Head of Risk Analytics and Model Risk en Morgan Stanley. Edward Altman, Autoridad Mundial en Riesgo de Crédito y creador del C-Score. Sophie Marnhier-Foy, Head of Product Marketing en Calypso Technology. Y como anfitrión, Gerardo Salazar, Chief Risk Officer de Grupo Financiero Banorte. Agradecemos a Calypso por hacer posible esta mesa redonda. Welcome John, Eduardo, Edward, Sophie, and Gerardo to the Risk Management and Trading Conference 2021.
Well, thank you very much. As we all know, risk and risk management is an inescapable part of economic and financial activities. People generally manage their affairs to be as happy and secure as their environment and resources will allow. But regardless of how carefully these affairs are managed, there is risk because the outcome, whether good or bad, is seldom predictable with complete certainty. All businesses and investors manage risk, whether consciously or not, in the choices they make. At its core, business and investing are about allocating resources and capital to chosen risks. In the decision process within an environment of uncertainty, these organizations may take steps to avoid some risk, pursue the risks that provide the highest rewards, and measure and mitigate their exposure to these risks as necessary. Risk management models, processes, and tools make difficult business and financial problems easier to address in an uncertain world. Risk is not just a matter of fate, it is something that organizations can actively manage with their decisions within a risk management framework. Risk is an integral part of the business and investment processes. Even in the earliest models, returns link directly to risk, but requires that risk be managed optimally. Proper identification and measurement of risk and keeping risk aligned with both appetite and goals of the enterprise and/or the individual investor are key factors in managing businesses and investments. Good risk management results in a higher chance of a preferred outcome, more value for the company or the investment portfolio, or more utility for the individual. To summarize, everybody knows there is risk in nearly everything we do. In this panel, we will focus on how the current situation is reshaping financial risk management, and with the pool of talent that I have in front of me, I am sure we will have a wonderful experience. So, gentlemen, first of all, you are very welcome. It is an honor. And to start, and please, in no more than 4 minutes for each of you, what would you say are the two most important areas, factors, or drivers reshaping financial risk management in the present circumstances? How about that, Sophie? Could you please make us the honor of commenting on that, please?
Of course. So good morning, good afternoon. Thank you very much for inviting me. As you said, risk management is key in many areas. And I think in 2020 and 2021, it has been a topic that was very important. As we all know, the COVID period has been very sad, first of all, but it has been also an experience where, from a risk management perspective, I think that firms and vendors have learned quite a lot, right? And I think now is a very good time to take a step back, look back, and see what we have learned from that past year that was so unique. With such unexpected market movements and changes, right? So it's very hard for me to give you only two trends. So maybe I'll give you my kind of input, and I will conclude with the two major ones, because so much was happening. And as a vendor, we've been working with our clients, and we've been actually noticing quite a few trends that are meaningful to discuss today. So let's start with the first one. I think the first trend is the fact that there is a market need for more sophisticated risk management tools in the credit risk space. And those tools have to be not only end of day, but they have to be real time and intraday. So I would say that's the first dimension. Then in parallel, from a market risk perspective, there is the same requirement for more advanced tools. Why? Because, well, the market has moved unexpectedly, and we've realized that the traditional tools maybe were not enough, right? So specifically, actually, I work with my colleagues and we wrote a paper on predictive stress testing to try and define a method to anticipate unexpected market moves, finding a way to go from macro economic trends, zooming onto the tail risk, and on that tail risk being able to actually run some very specific VAR calculation to effectively identify the high risk and provide or propose the correct hedging solution. It's a tool that can be proposed. There is no magic behind that, but that was a very interesting thinking to actually try and define that methodology. So counterparty credit risk, market risk, and then there is also clearing risk. As you all know, clearing is a trend, a market trend that is expanding, and 2020 was a key year for clearing, maybe driven by the uncleared margin rules, maybe driven by the higher counterparty credit risk. We've seen a big spike in clearing volumes. And what it meant is that in the clearing space, there has been a need to adjust to identifying and calculating the exposure and defining the margin calls that would be calculated. It was quite challenging because in that space, you always have to manage the procyclicality effect. On one hand, you want to be very conservative in the way you calculate and monitor risk. But on the other hand, you have to make sure that the margin calls resulting from those calculations will not be oversight and will not create market instability. So quite a lot was happening, and we've seen the margin methodologies actually quite efficiently being handled. There were some very nice statistics produced by the group CCP12 that were showing how CCPs have been very resilient and they've been managing the procyclicality effect very, very well. So now we've talked about counterparty credit risk, market risk, clearing risk. And I would say, generally speaking, and maybe that would be one of the two first trends that I would highlight, is there is this need for an additional and more sophisticated risk management monitoring tools, a systematic way of anticipating risk management, not at a specific point of time in the trading cycle or not at a specific time in the day, but throughout trading, throughout the life cycle, this constant need to be there and monitor the risk because it was actually moving so much. Another trend which is also driving that risk management trend is the adoption of the Basel III framework, the Basel framework, right? We have key milestone in September 2021, in 2022, 2023, and 2023, it's tomorrow, right? So what does all of that mean from a system perspective? And maybe that's the trend number two that I would highlight. We are seeing a need for systems that would calculate way more risk metrics with a much higher frequency. But at the same time, firms need to manage their costs, and most of them try to reduce their TCOs, right? So what do we need? Well, we need to be able to provide firms and the market with more, but with less cost, right? So less to do more, kind of. And I would also highlight the fact that on top of that, so being able to do more calculation at a cheaper cost, we also need to provide tools that leave way for the unexpected. Because what we have learned this year is that we cannot predict everything. So there is a need for a lot of calculation, a lot of new tools, but room for the unexpected. And I guess that would be my final comment.
Okay, Sophie, thank you. Thank you very much. That's very interesting. I'm sure we're going to get back to that in a minute. Meanwhile, John, could you tell us the two main drivers that are reshaping financial risk management at the moment, please?
Sure. Yeah, thanks very much. Welcome, everybody. It's been a long day. I'm glad you've all survived till the end. Yeah, I guess, just choosing. I was a little bit like Sophie. I found difficulty just choosing two. The first thing I thought of was the phase out of LIBOR. If we're talking about what's going to reshape financial risk management, the fact that LIBOR will no longer exist is obviously one thing. But, I talked about that in my keynote this morning, so I'm not going to talk any more about LIBOR. And the next thing I thought of was the fundamental review of the trading book, which Sophie touched on, which is going to come into place in 2022 and change things quite a bit. But actually, I chose two other things. The first thing I chose was the trend towards big data and machine learning. I think this is an important trend that will reshape financial risk management. In finance, we are actually very lucky that we have so much data. We're awash in data. And using this data intelligently, in the best possible way, is very, and trying to use it better than the competition is going to be very important. And there's been huge strides made in machine learning. Computers are a lot faster than they used to be. And, I think machine learning is just going to have a bigger and bigger impact on finance and on risk management. I was sort of billed as an expert in derivatives, but it's kind of interesting. I don't actually teach derivatives at the moment. My teaching has entirely switched to machine learning. And our students just understand how important machine learning is becoming. The electives for the MBA, for example, that I teach on machine learning are way oversubscribed. 3/4 of we have about 300 MBA students per year. 3/4 of those actually want to take this elective, even though it's quite a technical elective, because they kind of understand how important all this is becoming. It's the, automation was the third industrial revolution, and machine learning and AI is the fourth industrial revolution. And as I say, all aspects of a financial institution seem to be affected by that. So that's one thing. The other thing that I would sort of highlight is the trend towards decentralized finance. We've been using less and less paper money, of course. I'm sure everybody has. I think it's inevitable that paper money will be replaced by digital money that's controlled by the central bank. And I think this is a very important consideration for financial institutions because, after all, financial institutions are intermediaries, and there will be less money around for intermediaries. Intermediaries will make less money if we find other ways of paying for things, other ways of sending money from one person to another. I mean, if I want to send money to somebody in Mexico, maybe I can do that without a financial institution taking its cut at all. So most central banks are looking into what are called CBDCs, central bank digital currencies. And I think that, say over the next 5 years, we're going to see a lot of developments as far as that's concerned. And we're all going to start viewing money and how we use it quite a bit differently than we have done in the past. Thanks.
Well, thank you, John. Very interesting. Eduardo, would you make us the honor? I see some of the thoughts that you have shared with us. Could you be kind enough to share them with the audience, please?
Sure, thank you, and buenas noches to everyone. I think that this recent pandemic event and the impact it had in the financial institutions showed us, in my view, two important things that are going to define the future, is the near future of the banks. Number one is that the banks emerged from 2008 and through the 10 years that came after that, they built very large capital positions. The amount of core equity in the US banks more than doubled between 2009 and 2016, 2017, and since then it has been maintained very high. This made the banks very strong, go through the crisis, and very differently from 2008, I think the banks were pillars of support of the economy through the crisis. What this, in a sense, corroborated is the notion that stress testing, capital planning, and being very pragmatic about the amount of capital and liquidity that the financial system has been proven to be the correct strategy, and I think it's going to continue to be so going forward. The second thing that the pandemic showed us is that digitalization and the transformation of banks from a people material business into a digital business has been accelerated. So I think this is going to have tremendous consequence for the financial industry because the costs could be reduced very significantly by automation, by consolidation of the branch networks, by the substitution of currency by digital currencies, and all that is going to make banks more efficient and is going to allow them to increase the scale of the operations that they do globally. To me, those are kind of the two factors defining significantly the financial industry going into the next 5-10 years.
See, I guess we're living interesting times. When I hear and I begin to add what the three of you have just said, I think we're lucky to live and experience what we are experiencing. So, Edward, you're the last, and we are eager to hear from you. Please go ahead.
Thank you, Gerardo. Buenas noches, everyone. And it's a great honor, like everyone has said, to be with such a large and distinguished audience. So many of you may have heard the speech we just finished, and I may be repeating myself in a few cases, but in terms of the trends that we saw during the pandemic, which is in many ways a continuation of a trend that has been going on for 10 years, but it became hugely exacerbated during the pandemic. And it's the first time in my long experience that I've ever seen in a crisis, firms and governments, etc., increasing their debt to the level that we saw this past year. To give you an idea of the global debt increase, in 2020, the global debt increased by $30 trillion, led by governments and by corporations, less so by individuals and even less so by banks, mainly because of regulation for banks. So we had this huge increase on top of a dozen years of increase. And if you go back 20 years, global debt was a little more than 200% of global GDP. Today, it's almost 400% of global GDP. We have doubled the burden, and it's being hidden by the low interest rates that we are experiencing. So one of the things that I'm really concerned with is a combination of this huge increase in debt, which may, I don't know when, but I'm sure it will happen, be combined with much higher interest rates, especially if the inflation that we are now experiencing takes off more than the central banks believe. So that is the first trend that I'd like to highlight. And therefore, do we have the models? Maybe we do, to handle that increased risk. Because everyone is looking for higher yields. And The way to do that is to take more risk. So that makes risk models more important in general. The second area that I'm quite involved with personally, so it may be somewhat biased, is the concept of global zombies. And that is firms, they've always been supported by governments or regulators to some extent. But the trend, especially after this past year, is for the percentage of listed and non-listed companies being artificially supported and kept alive by governments, by regulators, by banks, by investors, is very concerning. Because when you have zombies, you have a misallocation of resources. And if that becomes exacerbated, then the productivity of the global situation becomes compromised. So those are the two areas, Gerardo. I could talk for a lot longer, of course, on stuff that we, personally, we all think is more important. But I'll turn it back to you now to perhaps start the panel in a more interactive way.
Yeah, sure, Edward. I am amazed. If I make the addition, we have 8 very important factors or drivers that you just mentioned collectively. And I will say a general question in order to start that interaction with one another. What is keeping chief risk officers awake at night? Surely is the 8 things or factors you just mentioned. And I would like to start with Sophie and John, if both could give us give the audience more elaboration on what these predictive stress test models and perhaps the trend for a cloud-hosted solution is going on. And I will just like very much for you to keep in touch with technology. I will make a comment right away after this Clear and Risk, the fundamental review of the trading book, FRTB. So what is your thoughts about that if you go in depth regarding those 2 topics, please?
Do you want to go first, Sophie, or do you want me to go first?
Yes, please go first.
I can go first. Well, let me say a little bit about stress testing. I think this is an interesting project that I'm actually involved in with my research group right now. And there's something in machine learning called the generation of synthetic data. So if you see the last 250 observations on the value of your portfolio or the changes in the value of your portfolio, that just gives you 250 observations. And yeah, you can calculate a 99% value at risk or, a 97.5% expected shortfall or whatever you want to from. But actually, you may be interested in much more extreme metrics. And in fact, I think the regulators are interested in much more extreme metrics, and that's why they use, stressed value at risk and stressed expected shortfall measures. But setting that aside, what you can do is to sort of look at the last, I'm giving 250 days of data as an example, and you can say, well, let's generate data that is indistinguishable from that data. It's the data that you generate has all the stylized facts that data has. It has, fat tails, and there's, the high volatilities are followed by high volatilities, low volatilities by low volatilities, all the usual stuff. And you can generate as much data as you want to that imitates the properties of the data that you're interested in. And then you can get much more extreme, value at risk or expected shortfall measures. So I think, that's, as I say, that's something we're working on right now. And I think it's, I think it's a really interesting, really interesting research project. We're getting some interesting results out of it. The other thing you mentioned was FRTB. And yeah, I believe FRTB is going to be implemented in 2022. We're almost there. The amount of work required to implement FRTB is huge, particularly if you're doing the internal models approach. You know, the number of different expected shortfall calculations you've got to make, you know, I see different estimates, maybe 60, 70, 80 different expected shortfall calculations just to, you know, each day to get the results you need for FRTB. So, you know, we need the sort of software that, you know, that Sophie can provide as far as that's concerned. It's, so I think it's, you know, it's really going to change the way we have to do market risk management because, you know, it's just, there's just so many, you know, so many calculations that are going to have to be done every day.
Yeah, so actually, thank you so much for that detailed explanation and to continue on the system part of the challenge. Effectively, as you said, the number of calculations that are required, whether it's the expected shortfall for FRTB, IMA, whether it's the addition of having to do UMR, NSACCR, and FRTB, all of that in a limited amount of time, because when you arrive in the morning as a risk manager, you want to see all those risk metrics ready for you. And then when suddenly the market moves in the middle of the day and you need to do a market data catch-up, you have to rerun at least an approximation of your risk. What does it mean? It means that as a risk manager, you cannot anymore run all the calculation you would like to run to assess and monitor the risk. It's pretty stressful, right? And this is where we are trying to help. So the trend we are seeing on the market is, or we are building for our clients, is ways to approximate, to use whenever possible a Greek-based approach, or whenever possible loading some data in memory because they are ready to be used, and only recalculate the part that needs to be recalculated because it's the only part that maybe is sensitive to a market data change, or maybe we don't need to recalculate the Vega risk because in that context, it's not that meaningful or that material, right? So this is really where we need to focus our energy to offer a solution where we only compute or we only use computation power when we really have to. And I would just add one thing, what's helping us a lot is the cloud and all the possible solution we have now to actually leverage, use data grid, calculation grid, elastic grid, which is a way to actually optimize cost and give back to the risk managers a little bit of the computation power in it.
I think that makes it very, very clear, Sophie. And I wanted to stress precisely that. But let me change gears here for a minute and ask Eduardo and Edward a very empirical question, which will be, do you see that we are all investing wisely nowadays? Just taking into consideration the kind of circumstance that you described that has happened with this COVID-19 issue, do you think we are taking or making wise investment decisions nowadays? What do you think about that, Eduardo, please?
So, sorry, investment decisions with respect to what?
Are governments and companies that have been asked for loans and borrow very cheaply, do you think they are investing wisely in this kind of circumstance?
Well, I think let me go a little bit around your question. I think that when you have interest rates like we had for so long, so low, the opportunity to borrow money at low rate and lock those fixed rates for long periods of time is very valuable. Suppose, for example, that inflation goes up to 4% a year in the US or something like that, and let's suppose it stays there for 4 or 5 years. Suppose that you have contracted debt at 75 basis points of coupon. You want to make a lot of money for your company for having gotten that loan at a very low rate when now you can remark your product at a much higher rate because of inflation. So I think that when inflation goes up, there is a transfer of wealth from the lenders, the borrowers, because the borrowers are able to fix the rate for a long period of time, assuming, of course, that this is not rolling short-term debt, that this is kind of long-term debt. Most of this stuff was. So I think that it's not surprising to me, for example, to hear the Federal Reserve to say they like the idea of inflation in the 3-4% range for some time, because that in fact is going to help a lot of the companies and a lot of the government that borrowed very cheap levels, and they're going to realize. So on the investment side, that part I don't know, because I don't know if the money that if the companies are getting this money and doing bad investments, which is a possibility always. Well, then of course this is going to have consequences. The same for the government.
Yeah, and it's very hard to look at history when you say the Asian crisis some years ago when effectively funds were very cheap and we saw some investment decisions which were very risky. So I was trying to put that into context because of the circumstances that we're living nowadays, like with more liquidity, as we all know, more automation, more digitalization, less people, less real estate, G7 making public choices, and so forth. But let's take advantage of your talent and let's give permission for the audience to ask their own questions. Do you have any questions? That's a great opportunity from you to take some of them. Please go ahead.
Thank you, Gerardo, John, Eduardo, Edward, and Sophie, for such a rich discussion. Indeed, it was interesting. How could it not be after such a year as 2020 was? To elaborate a little bit on the matter, we have some questions. First, I would like to ask Mr. John Hall, what new elements in reporting, modeling, and stress testing have to be implemented in derivatives clearing houses in the future?
Geez, what new models have to be implemented in derivatives clearing houses? Yeah, well, I mean, derivatives clearing houses have been, have been an increasingly important feature of the over-the-counter derivatives market. And, two banks, when they trade a derivative with each other, very often that derivative is settled through the clearinghouse rather than being settled directly between the two banks. So what models do they need? Well, they need to think about, worst case scenarios for sure. I mean, the sort of typical model is, if two members of the clearinghouse default at the same time, would the clearinghouse survive? If three members default at the same time, will the clearinghouse survive? So those are the sort of models they are using. And yeah, I think those models are becoming more and more sophisticated. I think there's a lot of regulatory oversight as to what the clearinghouses are doing. It's not something that I've done work in myself, so I'm just sort of talking at a fairly general level. But, I think it is, I think I would agree with the questioner that this is an area where we can see a lot more sophistication in the future. But it's, looking at those really extreme outcomes, the sort of 1 in 10,000 sort of worst case scenarios or something like that.
Okay, thank you, Mr. Hall. Now, I would like to turn my attention to you, Gerardo, because
I have another one from the audience here, and they're asking about RegTech or artificial intelligence and crypto trends. What are the industry expectations about RegTech direction and spend? Does an ecosystem view benefit RegTech strategy, or what do you think about these? When I see things like Merkle root hashes, timestamps, cryptography, peer-to-peer money transfers without not even a central bank or a commercial bank in between, What are your thoughts about that? What can we expect and in what time? What's the nature of the question? RegTech and the impact that those AI and crypto trends could have on us.
Great question, gentlemen, and ladies and gentlemen.
Well, I gave my views earlier, so I'll let the other panelists. But I think AI and machine learning, I think, is probably the most important area within AI. I mean, it's just going to have a bigger and bigger effect right throughout the whole financial services business, including in RegTech. You know, it's something we've all got, you know, the one thing that would keep me awake at night if I was a CFO is, you know, am I at the cutting edge as far as all of these sorts of new models are concerned? Have I got the right people working for me and so on?
Yeah, with respect to AI, I certainly would agree with several of the other panelists. Now, I'm an old timer in terms of looking at traditional techniques, and I had to be dragged kicking and screaming to start using AI and machine learning in some of my research and actually building models for practitioners. But I became a true believer in the last 2 years in two examples. First, if you think about credit risk and you go back several centuries, all the analysts had at their disposal was essentially soft and qualitative data. They didn't have very much financial data on counterparties, on individuals, companies, etc. And so they utilized very qualitative factors, you know, something about experience or location or industry. And then, of course, financial data became much more common, much more used, and the emphasis switched away from qualitative information. And now I think we've come full circle. The qualitative information and, of course, the related data that's available from the web and from social media and from other sources that were not possible earlier, has made this qualitative factor, as well as governance issues with respect to institutions, corporations, banks, etc., again, so important. And what we found is by adding artificial intelligence to the quantitative data, we were able to increase the accuracy of our models by 10 to 15%, which doesn't sound like a lot, but it is a quantum increase for models that had a certain level of accuracy for many years in terms of at least predicting defaults. And then all of a sudden, you had this increase through artificial intelligence. Machine learning, of course, artificial intelligence and machine learning go together. My concern with machine learning, however, is while they may give you pretty accurate results, it's still, for many people, a black box. And you really don't understand the interaction as well. Maybe John and his group or others are sophisticated enough to take a machine learning model and relate it to decision makers of institutions. I think that is the next step that's really important for it to be embraced by the larger community, rather than a lot of academic papers to start with. But maybe that's the way science moves. And finally, Gerardo, to answer a question that you asked about making intelligent investment decisions, I'm afraid most of us now are making decisions based on forced environment that we're in, a low interest rate environment, and one that regulators are playing such a much more important role. Just think about how important the movements of central banks were last March and how it changed the markets almost instantaneously. We've never seen that before. And And so every time there's going to be a shock to the system, we're going to ask, what are the regulators going to do? And how is that going to shape tomorrow's environment? And sometimes we'll get it right, and sometimes we won't. Anyway, those are some comments.
Yeah, thank you, gentlemen and Sophie. I will ask you another question that just came in. Talking about bank capital, to what extent should the spare capital be invested or utilized for buffers? I guess this has to do with TLAC from Basel. I'm just guessing, but do we need more buffers after we have seen or experienced?
Well, I'm no expert on buffers, to be honest with you, except there's always a question I get that I don't have a good answer for, but I know it's a really important question. And that is climate change and its impact on all sorts of risks. Will the buffers we have now handle major shifts in climate? Storms, heat, water. These are so important, and I just don't know if we have the models now and the buffers to handle that. But it's certainly a path that a lot of people are thinking about, asking about, and hoping that will, develop these.
Yeah, the sensation is on one side that the answer keeps simple and is the same as decades ago, since 1988 for Basel I, and that the question keeps getting more complicated with the passage of time. Because when you add so many risks, and the ones that you're saying, Edward, like sustainability risk, the simple answer is more capital, more reserves, more provisions. It is complicated, but well, the world is complicated as of now. All right. Do we still have time for some other question? I have several here.
Gerardo, thank you very much. I think we are running out of time, so I would like to put a final question to you all. Have we seen the worst of it? Are we past the worst of this turmoil, or can we still expect turmoil in the months ahead in financial markets, and therefore question the validity of our models? Gentlemen, ladies?
Well, I'm going to maybe provide an answer to a slightly different question, but I think in terms of preparing for all those adjustments on the aftermath of COVID, of the COVID crisis, and also preparing for those new Basel regulation, which we mentioned, right, FRTB, and also going through the LIBOR transition. I think the next coming months will be extremely busy for risk managers, and they will have to make a lot of adjustments to adjust to the new regulation, to the new way of doing risk management, and be ready for what might happen in the coming months of years.
Well, tomorrow the Federal Reserve is going to publish the result of the stress test 2021, and they're going to see how the U.S. banks did with respect to that stress test. I expect that the banks are going to pass the stress test very easily. They have a lot of capital, and I think what we're going to see tomorrow is going to be more dividends, more buybacks, and the bank stocks probably going a little bit higher than they are. They are already very high, but I think we're going to see very positive results coming from the stress test.
Yeah, that's the short run. I agree with that. There'll be, there's no question that the banks are very healthy now, and they're getting healthier, especially if interest rates rise for a while. My concern is not, are we over it now? The question is, what's and maybe Sophie mentioned this in the beginning, what's the next crisis going to be, and what will be the catalyst? Usually a catalyst is something we don't expect. Otherwise, it wouldn't be a catalyst. We would have already discounted it. So it's going to be something we don't expect. But my concern is, and I don't know if bank capital is going to be the only solution, but it certainly helps, is whatever the catalyst is, when we are much more vulnerable in terms of, I come back to the level of debt in the system, then the catalyst will have a much greater magnification effect on the outcome. If we had less debt out there, there would be, whatever the catalyst is, it would be less. And I don't know how we have, how we can have models to predict something that we don't expect. We can't put a probability on. That's always been a dilemma. But the short run is that this year we'll have unprecedented growth in economies. That will cover up a lot of problems. But just think about the governments and how much debt they're going to have to issue more to cover all the subsidies that they have given and will continue to give this year. Europe is just starting. The United States will probably pass an infrastructure bill very shortly. That's going to be, and nobody wants to raise taxes. Nobody wants to do anything to harm, I should say no one, but some of the legislators don't want to raise taxes to pay for it. So how do you do it? You pay for it by issuing more debt. It's going to be an ongoing thing. So I'm more concerned with the intermediate and long term.
Well,
Thank
gentlemen,
you,
thank you very much. It's been an honor. Thanks.
Gerardo, before we wrap it up, I would like to put a question to you. You are the CRO of a major Mexican bank. I would like to ask you, what new elements in models of market and credit risk have you had to implement in the last few months, 12, 14 months since the crisis started? How have you dealt in a very practical manner with this issue?
Yeah, well, some of the elements have just been mentioned. Some of them is that you review and manage risk more frequently. We have adopted in the derivatives realm, the XVAs, for example. We have been doing intraday stress tests, although the big ones are run daily. And we have monitored our risk more closely. And I agree with what Eduardo was saying, and also Edward, in regards that the health of the banking system is remarkable. And in the US, the banking system is preparing to pay dividends or buy back shares at the level of $146 billion, which is very important. And we expect within Mexico to follow suit. That is, we are expecting the same, because the Mexican banking system is so healthy, so solid, solvent, and liquid, that I think we're getting past through this crisis. So thank you for the question, and it's an honor to participate. And thank you for our panelists.
Thank you very much, Gerardo. And with this, we come to an end of this panel. Thank you all, ladies and gentlemen, for such a rich discussion, for giving us your insights and your perspectives. Thank you for being part of the Risk Management and Trading Conference 2021.
Thank you very much.
Gerardo, hemos llegado al final del día. Hemos llegado así al final del primer día de Risk Management and Trading Conference. Cuántos aprendizajes, cuántas ideas, cuántas perspectivas hemos escuchado hoy durante la jornada, y esto apenas comienza. Agradecemos a los patrocinadores cuyo apoyo hace posible la realización de este evento: Bolsa de Santiago, Madba Rofex, Bitso, GARP, Risk, SS&C Algorithmics, MathWorks, Calypso, Axiom SL, Murex, Fund Society y Global Risk Community.
Les recordamos borrar los datos de navegación, la caché, para tener actualizada la página de la plataforma y así no tengan dificultades para su acceso el día de mañana. Sus anfitriones, Claudia Echeverry y un servidor, Gerardo Herrera, los esperamos mañana para seguir aprendiendo lo último de los mejores en esta 10ª edición de la Risk Management and Trading Conference. Buenas noches y hasta mañana.